In the last month, the stock market has made a complete U-turn. 1 month ago, on October 27th, the stock market hit, quote, correction territory. What does that mean? The S&P 500, the 500 largest companies in the stock market, were down 10% from their highs in July. Now, since then, we have seen the stock market boom. In the month of November alone, the S&P 500 is up around 8%. The Dow Jones is up around 6%, and the NASDAQ is up around 10% in less than 1 month. Now, the question is, what is causing this complete flip in the stock market, and what does this mean for you? Let me start by talking about the 3 different factors that are contributing to this rise in the stock market so quickly. Number 1 is interest rates and the hope of interest rate cuts and no more interest rate hikes. Number 2 is treasury yields. I'll explain what that means. And number 3 is unemployment rising. Yes, unemployment rising. So let me start by talking about what's going on with interest rates, and we'll go from there. And we're going to end this video talking about what this means for you and your money. By the way, the reason you have a different background is because I am doing a little bit of a Europe podcast tour, media tour. So I'm currently in London right now. So what you're seeing behind you is downtown London. All right, talking about interest rate hikes. In the most recent inflation report, the data that we got was that inflation was cooler than expected. What that means is that CPI, headline inflation, came in at 3.2%, and core inflation, which is the Federal Reserve Bank's measure of inflation, came in at 4%. Both of these numbers are higher than what the Federal Reserve Bank wants. The Federal Reserve Bank wants to see inflation at 2%. However, these inflation numbers, the 3.2% and 4% inflation numbers, were better than what was expected. And because these numbers were better than what was expected, a lot of investors and traders are saying, oh, inflation is doing better. It's on its way down faster than what we originally thought. And because inflation is falling faster than what we thought, that means the Federal Reserve Bank will have to raise interest rates less aggressively. Maybe that means the Federal Reserve Bank won't have to raise interest rates again. Maybe that means the Federal Reserve Bank will start cutting interest rates. And these hopes of what might be happening in the future is driving people to put more money into the stock market, because higher interest rates generally mean a cooling of the economy, because higher interest rates mean slower spending. Higher interest rates mean less car buying. Higher interest rates mean less home buying. Higher interest rates mean less businesses borrowing money. So higher interest rates mean less spending, which means a slowdown in the economy. On the flip side, lower interest rates mean more spending. Lower interest rates mean more home buying, more car buying, more businesses spending money, borrowing money, which leads to a growth in the economy. And so that's what traders are betting, that the Federal Reserve Bank is done hiking interest rates and that the Federal Reserve Bank might be cutting interest rates soon. I'm not saying that's what's going to happen. I'm telling you what traders are hoping for. Now, one thing I do want to let you know about this inflation thing is how quickly sentiment can change on inflation. Because if we go back just a few months, in August, inflation came in hotter than expected. In September, inflation came in hotter than expected. In October, inflation came in cooler than expected. And so this big hope of no more interest rate hikes has been coming since the October cooler than expected inflation reports. Now, if we go back a little bit, if you take a look at August and September, when inflation came in hotter than expected, that created a lot of worries. And those worries were seen especially in the treasury market. So let me move on to number 2, talk about treasury yields and what's going on with that. Treasuries are loans that people make to the government. When people are worried about inflation, when people are worried about the economy, that pushes interest rates higher. Now, the Federal Reserve Bank raising interest rates also pushes treasury yields higher, but what that means is now the government has to pay more money in interest when you lend money to the government. Why does that matter? Because if you are an investor, and let's just say you have $100 or $1 million or $100 million to invest, does not matter the amount. What you're going to be looking for is, where can I get the best returns with my money relative to the risk? If you have one investment that has no risk and a 5% guaranteed return, and investment number 2, a 7% return, but a lot higher risk, now you're going to be making that question of, well, do I want the guaranteed 5% or a little bit higher return for a lot more risk? And that's the question you have to ask. So when we saw these worries of inflation in August and September, you saw treasury yields rise. For example, the 10-year treasury yield was around 5%. That means if you lent money to the government for this 10-year period, you would get a guaranteed 5% return on your money as long as the government doesn't default. That's a pretty good return, a 5% return. And so what we were seeing happen was a lot of investors, especially more on the institutional side, the bigger corporate investors, more money was going into treasuries because you could buy these bonds at a lower price and get higher returns. Now, what we're seeing is because of the last month's sentiment of inflation, treasury yields have started to come down. They're still very high. They're still in the 4.4% range, but it's not that 5% that we were seeing before. So what does that mean? That makes investing your money into other assets, such as stocks, a little bit more attractive. Because now if you have a lower risk-free return, now maybe you're looking for higher risk, higher potential returns. And the thing that's driving treasury yields, again, has to do with what the Federal Reserve Bank is doing. What are people's opinions on inflation today and inflation in the future? And what are people's opinions on the economy today and the economy in the future? If people are worried about the economy, if people are worried about inflation, you tend to see treasury yields rise. Higher treasury yields lead to higher interest rates and everything else. But this is where we're now understanding that these treasury yields impact many different parts of the economy, and you definitely want to keep your eye on the treasury market because this is something that can impact a lot of different factors, not just from lending to the economy, but also our government costs. So keep your eye on treasury yields as we go into 2024 because that's going to be something very interesting. This brings me to topic number 3, which is unemployment rising and how higher unemployment is contributing to more money going into the stock market. Now, before I talk about this, I do want to let you know that if you are interested in learning more about how do you invest your money, how do you put your money to work, my team at Briefs Media has a free ebook titled How to Build Wealth as an Investor that you can read for free. If you want to get a copy of the ebook, all you got to do is click the link down in the description below, and it goes over things like how do you start saving your money? How do you build the mindset of an investor? To how do you start investing your money? How do you invest your money for cash flow? How do you generate appreciation? How do you spend your money smartly? How do you earn more money so you have more money to invest? And how do you protect your assets? If you want to get a copy of the ebook, I got the link for you down in the description, or you can go to briefs.co/ebook to get a copy of the ebook for yourself. Now, talking about unemployment rising, why does this matter? Because slowly what we've been seeing is over the last number of months, unemployment has slowly been trickling upwards. Now, on a historic level, we still have very low unemployment. We're at around 3.9% unemployment, which over the last 30 to 50 years is still historically some of the lowest unemployment we've ever seen. But it's been slowly rising up because a few months ago, we were at 3.4% unemployment. Why is this good news for the stock market? Well, it goes back to what the Federal Reserve Bank has been saying. If you remember, around March, April, May of 2023, the Federal Reserve Bank got into a little bit of hot water. Now, this wasn't anything new. It was just, I think politicians started to understand what the Federal Reserve Bank meant. Because what the Federal Reserve Bank was saying was that in order to bring inflation down to 2%, which is what they still want to do, that we're going to have to see unemployment rise by a decent amount. And they had been saying this in 2022 as well, but it wasn't until the first to second quarter of 2023 that some politicians really started to understand what it means to fight inflation. And so that was when you had a lot of politicians attacking the Federal Reserve Bank saying, you want 2 million Americans to lose their jobs in order to cool down inflation. And Jerome Powell, the chairman of the Federal Reserve Bank, said, well, I'm not saying I want that to happen. I'm saying that's a consequence of fighting inflation. Anyways, higher unemployment, according to the Federal Reserve Bank, is a byproduct of cooling down inflation. So now, when we hear these reports nowadays, because we're seeing more and more reports on this, of unemployment slowly starting to rise, employers hiring less people, and seeing this what's called softening of the labor market, as an employee, that's bad news. Because that means it's a little bit more difficult for you to go out and find a job. However, for an investor, understanding what the Federal Reserve Bank is doing, what this means is maybe the Federal Reserve Bank won't have to be as aggressive to fight inflation. Why? Because if you're seeing higher unemployment, maybe that means the Federal Reserve Bank is hitting their goals. Maybe that means the Federal Reserve Bank is reaching the target closer of inflation. Now, inflation is still high. Core inflation, the Federal Reserve Bank's measure of inflation, is still coming in at 4%. That's double what the Federal Reserve Bank wants to see. We're still seeing high inflation. However, one of their so-called byproducts of fighting inflation, higher unemployment, is starting to happen. So you have traders saying this is good news because that means that maybe the Federal Reserve Bank won't have to be as aggressive when it comes to interest rate hikes. So what does this mean for you and your money? Now, I do not want you to be a trader. A trader is trying to predict what's going to happen next month or the month after that, or maybe the month after that. They're trying to look at these financial cues and try to buy things or sell things based off of what might be happening in the next 30 to 60 to 90 to 180 days. What I want you to do is be an investor. And the way you win as an investor is, number one, either you're a passive investor. Every week, every 2 weeks, every month, you have money going into the market. It does not matter what's going on. And so if that's you, none of this news really matters. Like, for example, I have a passive investing system where every Wednesday, money leaves my checking account. It's automatically invested into my portfolio of ETFs, these funds in the stock market. So every Wednesday, I'm buying more stocks in the stock market. It does not matter if the stock market's up, does not matter if the stock market's down, does not matter what the Federal Reserve Bank is doing. It does not matter what's going on with inflation. It does not matter what's going on in the economy. Buying more stocks every Wednesday. And I'm not telling you what to do. I can't tell you what to do, and I don't recommend you do what I do. Just telling you what I do. That way you can understand a little more where I'm coming from. I also have an active investing method where now I look for good companies that I believe are undervalued. Now, in this instance, if you want to be a little bit more involved, what you do is you look for a good company that you think is on sale. And if you see economic pain, that creates more sales. So that means now you want to be looking for opportunities. And opportunities are created in every market. And especially in this economic climate, you have a lot of emotions out there. If you look back just 1 month ago, we were in correction territory. 1 month ago, the stock market was in correction territory. Today, we are in boom territory. And this is where now understanding how can we see such drastic changes month over month. There's a lot of emotions out there. People don't really know how to understand this inflation issue. People don't understand what is going to be the impact of higher interest rates. People don't know what the Federal Reserve Bank is going to do. So you have a lot of emotions flying around, a lot of money flying around, but this is where I want you to stay calm and understand what is the impact of inflation. That's going to continue impacting people because we still have high inflation. That means things are still growing in price faster than a lot of people's wages. We still have high interest rates. These have impacts on the economy. We still have a lot of debt that is readjusting in 2024 and 2025. That's going to have impacts on the economy. And so while a lot of people are getting emotional, I want you to be a financially educated investor, stay financially calm, understand what's happening, and build your financial education, because every economy creates opportunities, and you want to be the one that's looking for opportunities, not the person that's chasing the hype.